Right, here we go with a little bit of hedge accounting, things that people tend to find quite difficult, but know the basics. And as usual, these things are quite straightforward. So to qualify as a hedge, first of all, you need to formally document, right, this is a hedge that I'm going to do, right? And so to do a hedge, I need a hedged item and a hedging item, what we call a hedging instrument. So you need two things. You need to formally document it, and it needs to be effective. You need to expect it to work. So the idea is that you might get a loan and you're worried about the interest rate going up. That's the hedged item, the thing that you're worried about. So you get a hedging item that goes in the opposite direction to it, such as a derivative. We'll go on to that in a bit more detail now. So there's two sorts of hedge. The first hedge we're looking at is a fair value hedge. So what you're worried about is the fair value of your loan or your asset may change. So the thing that you're worried about is the hedged item. So it could be a fixed rate loan. So let's say it's a payable loan. You're worried about interest rates going down because then you're stuck paying a higher amount. So what you do is you get a hedging item that will go in the opposite direction to it, some sort of interest rate derivative. You just need to know that they work in the opposite directions and they'll probably be quite level, quite effective. So this is a fair value hedge when you're worried about the fair value of something changing. So as the value of the fixed rate loan goes down, your hedging item or derivative value should go up. So the question is, well, where do I put the difference in the gains and losses? Where do I put them? Well, no matter what it is, you put the gains and losses to the P&L. So therefore, they're matching nicely in the P&L, aren't they? Simple. That's it. Hedged item, hedging item, fair value accounting. Now, the other one is a cash flow hedge. Works quite similarly, but the difference between a cash flow hedge and a fair value hedge is the future cash flows you're worried about. So you're worried about something in the future happening, not now. So the future cash flows, often in the exams, it's some sort of foreign receipt or payment you have to make in the future. And you're worried about the exchange rate moving against you. So the thing that you're worried about in the future, that's a cash flow hedge. That's the hedged item. So as I just said there, forecast foreign sales, the exchange rate you're getting. So you go out and get a hedging item, some sort of exchange rate derivative that as one goes down, the other one goes up. Now, in a cash flow hedge, you're worried about the thing happening in the future. So the hedged item doesn't happen yet. It will happen at some stage in the future. But the hedging item that you've bought, that will be going up or down in value. So you put that to the OCI. So it's just one extra step. You put the hedging item gain or loss for the first bit to the OCI. And then, in the end, the exchange rate will move against you or in your favour. And when it does, you put it to the P&L. And then you say, yeah, but I also had some of that stuff in the derivative in the OCI, didn't I? So I will reclassify that from the OCI to the P&L. So they're matching again in the P&L. So you're just waiting a bit. Okay, let's do a little example. So you can see here, look, as soon as you see it expects to buy goods in the future. Oh, there's two of me there, look, hello. One's bad enough. Okay, so you know, because it's a cash flow in the future, you know it's a cash flow hedge. And then it says it's a forward contract. So the forward contract is the hedging item, isn't it? Okay, and then you document those two. Remember, you have to say like, this is the hedged item, this is the hedging item. Got to document them. You've got to say, I expect them to work more or less effectively. Okay, so how do we deal with it? Well, see at the very bottom there, it says the forward contract had a 4,000 gain. All right, and the foreign purchase hasn't happened yet. So what do you do with the 4,000 forward gain? Goes to the OCI, just holds it in the OCI. So literally debit forward contract asset because it's made a gain, credit the OCI with it, 4,000. Okay, and then eventually what will happen is we will, in 3 months' time, when the goods are bought, the exchange rate will have moved either in our favour or not, and that will go to the P&L, and everything that we had in the OCI will also get taken out of the OCI, debit it, and credit it to the P&L, and that's it. So, to summarise, cash flow hedge. The effective portion, yeah, we presumed in that last example everything's effective, often is in the exam. But the effective portion of the hedging instruments gain loss goes to OCI to begin with. If it was ineffective, that portion goes to the P&L. But anyway, the effective portion goes to the OCI until the hedged item actually makes a gain or loss, and then you move that to the P&L from the OCI when the hedge cash flows occur. On a fair value hedge, much more straightforward, isn't it? Gains and losses on both the hedging and the hedged item go straight to P&L, and you've balanced them already. Okay, I hope that little breakdown helped.